Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlotnik. Today, it is my pleasure and a privilege to welcome again Alastair Macdonald. Hi, Alastair.
Hi there, Mike. Great to be here.
Thank you for joining us again. This is a part two of a great discussion. And let's pick up where we left off. So interest rates. Let's just cover this a little bit more. So we had substantial increase of long-term interest rates in the United States since the beginning of the year as the economy continued to recover and the government was writing a lot of checks. What do you think is going to happen next? The rates seem to have stabilized a little bit and they're not rising as fast anymore. Did we reach a temporary peak? Are we going to slow down somewhat? Is the Fed taking action, as far as you know, to slow down the rates increases, sort of form of a quantitative easing or mortgage-backed security purchases? Just curious, what do you think about where we are going with interest rates today?
This is a really important subject, and I certainly would want to address that question, but I would also like to share the most crucial piece about interest rates that nobody seems to be paying attention to, that I think speaks to a much larger risk than simply that of a protracted period of rising interest rates, which in and of itself is extremely dangerous anyway. The turn up in interest rates on the US long bond that began in July, August of 2020 it has, by many measures, a lot of technical, just analyzing the charts, the behavior, the flow of funds, as well as fundamental reasons. There's a lot of reasons to be concerned that low in interest rates was the low for the 40-year cycle of falling interest rates, which has been the backdrop to and largely the turbocharged fuel of so much of the asset explosion in values over the last 40 years, which is without precedent in US history. So though I have some long bond positions right now because I believe that they're currently oversold and due for a pullback here in the third and fourth quarter of the year, there is a lot of structural reasons to be concerned. As I said, that the low that we saw in 2020 could be the low for the cycle. Now, I say that as somebody that has been very bullish on long-term bonds for some time. I think that party, there's evidence to suggest it may actually be over. To splice apart what we refer to when we say interest rates, it's important that we separate the quality of interest rates or the quality of debt. So when we see a turn up, a significant turn up, say just in the performance of the 10-year note, which had a low of 56 basis points, and is now at 1.7, 1.8 almost, that's not a 1.5% increase. That's a 300% increase in the cost of money, cost of capital over such a short time frame. This is one of the important risks that we overlook when interest rates are low. And it shows up for entrepreneurs as saying, I'll just take out a loan that they're lending it to me at 3%, etc. Totally, yes, that is cheap. Relatively, it's not at all. All that it requires is a 1 or 2% increase in interest rates, and we've effectively 50 or 100% increase in the cost of capital. So for companies that are at this stage in the business cycle that are needing access to short-term capital with unsecured interest rates, they are taking on risks that the last 40 years of bull market and bonds has blinded them to. And I think that's a very, very important thing to consider. So I have some concerns that they've turned up. What bothers me is that we've seen a rise, a rally in junk, and what we really should call junk, but now you've called high yield bonds, whilst government bonds have done poorly. This is a relative outperformance of risk versus security. Should we see anywhere near the same turn up in rates with junk bonds as we have with high quality? this whole hot money episode that we're living through is going to come to an end. If we were to see a threefold increase in the price of junk bond yields, that's a market that would face a very, very large downside fall. I don't wish it, but it's just interesting. If it's good for the goose, it might be good for the gander.
Yeah, that's great commentary. I really love the key point you said. The increase of long-term rates from under 0.5% to where we are now, it's a threefold increase. The cost of money has tripled for those whose loans are pegged to the long-term bond. And the other point that you finished your sentence was that the junk bond yields, the risk-adjusted return is just not there. People are paying obscene prices for the risk that they're taking, and they don't even realize it. So it's a danger zone. It's a massive danger zone because there's a lot of junk bonds. It's probably largest part of the market at risk now. And if that trench is considered to be riskier and the investors start demanding high interest rates, you're right. Cost of borrowing could go up, and then it could put a lot of brakes on the economy, massive brakes. I mean, this is I not in contrast to what you're saying, but I also just want to point out there is an opposite opinion to what you mentioned, that the interest rates have hit the bottom and they are now bounced off the bottom and we're climbing up. There is the grand conspiracy theory and then the Japan model that the interest rates haven't reached the bottom. This is a temporary uptick. And then at some point, U.S. government will stop spending money the way it's spending now as a drunk sailor. At that point, we will go back in a deflationary environment and the rates will go towards the Japan model. They'll go into negative territory. And when debt to GDP ratio gets so much out of control, you don't have a choice. You just need those very low or negative interest rates to keep the thing afloat. So
I share those sentiments. Exactly. You're exactly right. And that is actually my expectation. I'm simply speaking about what concerns me in the more recent past of the last 10 or 12 months about interest rates. None of these are forecasts. It's more concerns, the things that keep me up at night, so to speak. What if I were to make one forecast is by the completion of this cycle, if we consider what we're through, still a half cycle with a very modest correction in asset prices last year with COVID, very modest, considering standard bull market corrections, that was fast, it was violent, but it wasn't particularly large. The one thing I am confident about is that credit quality spread between junk and high quality will widen. And when that happens, that could happen either by junk bonds yields staying where they are and US government interest rates and high quality rates falling, or of course, them staying where they are and junk bond yields rising. There's a number of ways that can be achieved. None of them end well for high yield and junk bonds right now. To your point of the risk adjusted return, is just makes it one of the worst possible investments one could make right now. When we look at things like HYG or JNK, just simple ETFs for your listeners to track, and we see yields of 4.5% in an ETF basket that has a 6.8% default rate. This doesn't make any sense. You're getting lower yield than you have a default rate. And that's a 50-year default rate, of which the vast 40 of them have been boom times. So there's a lot of reason to doubt this ebullience about junk bonds right now and cheap and high risk credit.
Yeah, the most fascinating thing is I don't know if you probably are aware of infinite banking and the whole life insurance investing, and I've had a number of conversations with folks in that industry, and effectively the insurance companies don't know where to put the money. They're chasing yield. That's one of the reasons they're buying less quality bonds, because they need to park the money somewhere. And there's a ton of money chasing yield, and that's a big problem because quality yield is just not exciting enough for them, and they wind up in the junk yields. And it is a danger zone. Like you said, default rates are ahead of the yield coupon that you're collecting on the bond, which is you're effectively operating with expectation of a negative return. So
yeah, excellent. You're so right on, and this is an important thing for all of us to be aware of. This search for yield pushes otherwise conservative investors out onto the frontier of very, very sketchy markets. It also pushes hot capital into industries that up until now have not been victims of it. We've seen it in dentistry, where 3 years ago, we were seeing 15 times EBITDA sales on dental practices. I was at a dear friend's conference speaking there, and I stood and I said, we are late cycle in hot money in dentistry. And this is essentially the high water mark. Now, those same practices selling for 5.5 times EBITDA. There's a 66% implosion in the multiple of people we're paying. That hot capital is now poured over into another industry of which I am participating, which is veterinary space. I received literally on Friday of last week an offer to buy my 6-doctor veterinary hospital for 13 times EBITDA, and not a 3-year smoothed EBITDA, the trailing 12 months. It's so, and of course, and I've spoken with friends and on my own podcast, I knew this was coming. It's nothing amazing about me, but once you understand the flow of capital seeking a yield, you know where it's going to go. Pain clinics, dental practices, veterinary care, this defensive-oriented industries that they feel, well, everybody has teeth, everyone's going to need to go to the doctor, et cetera, et cetera. And with it comes all of the complexities of running these businesses, legal, medical, compliance, and oversight. They're far more complicated than these private equity groups are aware.
Yeah, it's fascinating. These professional investors, they're operating like Dumb and Dumber money. I hate to put it this way. I mean this all due respect, but they're overpaying for the assets because they got nothing else to invest in. But now let's talk a little bit, shift the conversation just a little bit about the possibility of a cliff. So the government is spending a ton of money, and a lot of people have substantial concerns. When is the party going to end? I mean, drunken sailor, the government is writing a ton of checks. Now we're dealing with one party controls all parts of the government, the House, the Senate, the White House, and they are intending to spend as much as they can possibly spend, and that appears to be taking place. Also, in parallel, there's an attempt to increase taxes. The Biden proposed latest tax increases are almost counterproductive. There's one part I'd like you to comment on it, is that the increases in the capital gains rate. What's really fascinating historically, they reduce revenue collections, not increase it, because the compliance and avoidance goes through the roof. So they're trying to raise revenue. I think the result of this will be, most likely, it'll be very counterproductive on capital gains side. Obviously, they'll increase revenues if they increase the rates based on withholding. People can't really do much about that. But is there a cliff? At some point, the government can't continue to do what they do. I mean, they are in a crisis mode spending spree. Will this end at some point? Maybe it will end when the Republicans take the House in midterm elections. Again, we don't know that, but it's a possibility. What will happen at that point? Are we looking at a substantial slowdown in the government spending? As a result, the economy will not have all that fuel, or the economy will have enough momentum that it'll keep rolling even without the government massive expenditures?
Well, this is such a big deal that if we look at household incomes for the first quarter of 2021, they appeared to have a 6% increase, which everybody is very excited about. But if we strip away government transfer payments, they have actually been flat since October of last year. So this is a big deal. And what's happening is governmental money is starting to crowd out regular small business. We've found ourselves over the last 18 months having to compete with the government simply to keep people employed because the incentives and packages and so forth are so deleterious. In fact, 2 professors at the University of Chicago in February did a deep analysis on the Biden plan at that time's iteration of it, which is barely modified at all as we see it today here in May of 2021. And their research made the case that this is not going to support jobs, it's going to destroy them. That what they used as a sample couple, a husband and wife couple in Kansas, that had both lost their jobs and had 2 children, annualized the benefits that they stand to receive between additional stimulus, standard federal support, and state unemployment benefits, etc. The household annual benefits annualize out at $140,000 a year. This is for two unemployed people with two children. In the state of Massachusetts, where the unemployment insurance is the highest, that same couple stands to be compensated $170,000 a year. So imagine that how many businesses, first of all, and how many of those businesses have positions, employees in their stable that are earning more than 140,000. How many of us can afford to compete with Uncle Sam? And this adds, I have been leaning toward a fear of debt and asset deflation for a long time as being the real threat. We caught a glimpse of it during the financial crisis. We caught another glimpse during the credit freeze of COVID and so forth. But this is the first time in my experience in the United States where inflation suddenly becomes, and this is a change of expectation for me, that inflation is a legitimate concern. And it has not been a legitimate concern outside of episodic supply chain type breakdowns and so forth, which are all transitory in my opinion. But for the first time, and the reason that it hasn't been sustained and rather episodic is the one critical piece is incomes. We need to see a rise in incomes sustainably for inflation to get its foothold. The government is doing that. And this is a very dangerous precedent. To get more specifically to your point, though, when does this end? Will the government stop? The answer is, historically speaking, no. It won't be an event. It will be a process, like so many, just as the fortunes of a company might rise and fall, just as that old saying in asset markets, a bull market climbs a wall of worry and slides down a slope of hope. This is a slope of hope. And in my experience, as both an employer and an investor and a strategist and advisor for many years, one of the bedrock principles of my belief in discovery is that once somebody acquires a benefit, nothing short of death will separate them from it. And how quickly benefits become entitlements, that happens faster than the ink dries on the check. This is what we're dealing with right now. How are we going to convince that household to sharpen their skills, upgrade to a globalized AI type economy and so forth, and get back to compete? And even if they do, how long will it take them to surpass that $140,000 benefit for doing nothing? Now, this is not to say that I don't, of course, I believe that we need to take care of the most unfortunate in society, but this is vote buying and pandering of the highest order. And I want to point out, because it's very easy for us to get partisan about this, this began under a Republican administration last year and is merely being accelerated by the new one. I'm less enamored with red versus blue. I'm more concerned about bad ideas than bad people. And there's a lot of them out there right now.
Yeah, it's a drug. It's a cocaine of this economy. It's boosting this economy, and you absolutely correct. It is a massive competitive pressure on the private business. I had a call with the CEO of a company we're close with, working with. He's trying to hire. He can't find qualified people. It's so hard. It's just because the government dollars are competing with the private employment opportunities, and many people are just choosing to stay home, enjoy their free time, and get the same pay as they would if they worked in a private enterprise, where they would have to spend their 40 plus hours a week. So that you can't compete with Uncle Sam. At the same time, it feels like if there is no programmatic slowdown in this is going to be out of control. This, like you said, from help to entitlements, it's a very short path. And once people get used to this, if you withdraw this, there's going to be massive, withdrawal pain from a lot of people, and that's not going to be well received. So politicians are very concerned about their electability. So we're going to get accustomed to this, and at the real level we're spending, I don't know how much debt we're acquiring versus the GDP growth. it feels like this is going to get out of control. It can't create, like you said, real inflationary environment, the wage inflation, and then the continuous, it's a spiral. It's an accelerating spiral.
Yes.
Hopefully, it's not going to be like your country of home, or Zimbabwe, where you have to pay for lunch before you order it.
Yeah, that hyperinflation seems some way off, but it certainly, we extrapolate the trends that are now just forming themselves, and that doesn't quite seem as far-fetched as it did to me just a year ago.
Well, but let's take a step back. Is there a possibility that the government will just not want at some point, or will desire to slow down this crisis expenditures? Is this a real possibility where the government says enough is enough? You have, let's just say, midterm elections, Republicans take the House and they say, hey, this is crazy, so expenditures stop. A lot of there may be a phase out timeline, or it can be hopefully not a cliff where the government says enough is enough, unemployment will run out, will stop. What do you feel? Is this a real possibility, or like you said, once you get used to the cocaine, you can't get out of it? Get that stopped. So what are we looking at? A real scenario? Is a cliff a possibility, or the government is just going to continue to extend unemployment benefits, continue to provide all kinds of other support, and just keep borrowing and keep feeding the economy with cash without creating the jobs?
Yeah, it's a two things. I think that we will go through. I anticipate a fairly ugly third and fourth quarter of 2021, as a lot of these benefits time out and so forth, and as the data begins to reveal itself as how much of this is being supported by temporary, unsustainable benefits. So I think Q3 and Q4 will be where the rubber meets the road. To the possibility of a governmental initiative to cut back these incentives, I think that's extremely unlikely. And evidence, we just have to remember two critical things about the political process. The first is it's not their money. And the second is they will always move toward buying votes. They'll always do that. They do that everywhere. That's what success in politics looks like, is popularity. It's also worth remembering that, as remarkable as the stimulus package was, President Trump, before he left office, said that's not enough and he would do more. And I think it's not about the characters, but it is about the philosophy of desperate people approaching a voting situation, a vote that is critical for them. They will absolutely outpromise each other. So is there hope that a Republican kind of lighthouse will emerge in this next midterm cycle? It's possible. The question is how much damage will be done in the form of this free drug given to both red and blue voters between here and there, because I think that will dictate how they will have to adjust. To have the Democrats show up and say, we want to do a 1.9 second round of stimulus at the end of last year, and have the seated president say, I want to do more, that's a conservative. I think that, again, it doesn't matter what we think about the individuals. This is about what motivates political interest. There's no benevolent overlords at the end of the day. And, the history of our respective home countries just makes that more stark, but no more different.
Yeah, that's a great wisdom. Thank you. So, but you said something contradictory. It's almost not contradictory, but it's kind of puzzling. So, if you expect Q3 and Q4 to be, it's where the truth is revealed when some of these benefits run out. On the other hand, you're saying that there is no political will to stop. To me, it's a little bit of the contradiction. It's almost like they won't let those benefits run out. People are going to still continue to get benefits. They'll find a way to extend them. So why is Q3 and Q4 a danger zone for the economy?
Well, you're right, and not so much contradictory in terms of a forecast, but contradictory in the possible outcomes. This is the situation that the current administration is going to have to address. And the reason that I think it's going to be a challenge for them is the beauty and the poison of unsustainable support is that it looks like it's okay to start taking it away. And the same problem has been, the same error has been made repeatedly by the Federal Reserve. Let's remember that it was just going into 2021 that the Feds felt this is a perfect time for us to start raising rates. It's showing up again now in the Fed's narrative and notes of just the last couple of weeks that by the third or fourth quarter of this year, we should be able to go back to raising interest rates. They've always shown up too late with the wrong policy, where it looks like it's working great, we can take it away, and they realize that the bulk of this life support, excuse me, as unsustainable as it is far more baked into the pie of everybody's assumptions than they realize. And this gets to something that I'd love to touch on, where I'd say there's a critical piece about interest rates that nobody's paying attention to. It's worth remembering what interest rates are meant to represent. They are an indication of risk. That's what an interest rate serves, as an indication of risk. There is a myth we touched on in our previous conversation that the government or the Federal Reserve controls interest rates. This is an absolute fallacy, and it is an expensive fallacy. It is a fallacy that people believed all the way through Lehman Brothers' bankruptcy, all the way through the financial crisis. And this is because myths can endure longer than our willingness to see them as such. But the Federal Reserve doesn't control interest rates. They simply control the rate at an overnight level that they lend it to a handful of small institutions. They had zero control over the 5, 10-year, 20 and 30-year bond issues. They don't. This is something that even Bill Clinton didn't understand. In 1996, in meeting with Larry Summers, he said, well, let's lower the interest rate. And Summers said to him, we don't get to decide. And this came up in our last conversation. It is the lender that decides the rate, not the borrower.
That's right.
Ever. So the notion that they can control interest rates, they're not. So what they've done by suppressing the natural rate of interest is they have broken the most valuable light on the dashboard, which indicates degrees and degrees of severity of the risk that something represents. When I'm getting nothing on my 10-year government note, the jump to 3%, 4% for junk seems like a very small leap, but as a risk profile, it is a giant leap. And this is what happens when we break the fundamental structure and value that interest represents, which is an indicator of risk. We completely create a massively artificial asset bubble as people misinterpret risk profiles and find themselves buying investments that they have no business owning. It also drives people into, given that we're in effectively a zero interest rate environment on an inflation adjusted basis for so many assets, of course, we're going to be driven to speculate in NFTs and Dogecoin and all of these things. Why not? Why not? We're earning nothing in our bond portfolio, et cetera, et cetera. So this is the risk of artificially suppressed interest rates over time as they break the risk pricing mechanism.
That's right. That's actually a great wisdom, and we all, the way I put it, because some of the business what we do, we lend money on fix and flip projects, and we charge hard money rates, and those rates represent real risk. I can't imagine if we had to lend in the government rates. It's almost like the joke that I crack is when the government lends you money on a 30-year mortgage at these very low interest rates. It is it is nothing but a massive subsidy, because if the true risk-adjusted rates were in the market, you'd be paying a higher rate on the mortgage. That's the reality if you didn't have the government subsidy. So you're absolutely right that the interest rates, unfortunately, are artificially manipulated. And as much as you said, the Fed doesn't manipulate the long-term rates, for some reason, the market is just not pricing the risk properly. And maybe it is a global risk and a global problem, and when people wake up one day, we may have a substantial shake up in the interest rates. But when it happens, it'll be extreme volatility, and hopefully we're not going to get there anytime soon. Alastair, this was really awesome. I really appreciate your wisdom. All good things must come to an end. You ever heard that expression? We're running out of time. So time flies, but you're the pilot. Appreciate your wisdom and your time, and would love to have you back. Once again, please tell the audience if they wanted to engage you as a speaker, as a coach, or how would they reach out to you?
I think I embarrassingly mentioned last time, I don't have much of a web presence. There's a website out there, alastair.vip, alastair.vip, or otherwise Facebook is a simple way to reach me. I'm just a regular guy like everyone else, and always interested in talking to interesting people, and you're evidence of that, Mike. So thanks very much.
Thank you, Alastair. Again, I would love to have you back. We'll give you a little break. We'll give you a little space. You did 2 episodes. I'm grateful. Thank you kindly, and appreciate your wisdom. And we'll talk soon. Enjoy the weather, improving weather. Things are getting a little better.
It is. Thank you, Mike.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.